Welcome to the ongoing series of online discussions hosted by the Yale School of Management Office of Alumni Relations and QN, the Yale School of Management magazine. Today's conversation is Private Equity in Transition. Our moderator is Andrew Metrick, Deputy Dean for Faculty Development, and Michael H. Jordan, Professor of Finance and Management, who will introduce our panelists and kick off the discussion. We welcome your participation in today's discussion. You can submit questions and comments through the question box on your screen. Now I'll turn things over to Andrew.
Thanks a lot, Chris. I'm Andrew Metrick, and I'm going to moderate this discussion, which mostly means I'm going to stay out of the way while our distinguished speakers answer your questions. We really have a fantastic group today. It's a group that graduated during the golden age, as we like to refer to it here at SOM, in the first few years when we began our tradition of having fantastic classes, and many of them personally recruited by Bill Donaldson, our founding dean. Our three panelists today are Dan O'Connell, the class of '80, who is the CEO and founder of Vestar Capital Partners, a private investment firm managing over $8 billion in equity capital. It was founded in 1988, and it's been the lead investor in over 65 companies across a broad range of industries in both the US and Europe. Sally Rocker, class of 1981, has been a managing director and general counsel at J.C. Flowers & Co. since December 2000. J.C. Flowers serves as an investment advisor to several private equity funds which focus on making investments in the financial services industry, and my own editorial comment, a central role as one of the good guys in the financial crisis. Maybe Sally will tell us something about that. Peter Schulte, class of '83, is a managing partner and co-founder of CM Equity Partners, one of the first and most experienced private equity firms in the federal services sector. CMEP has completed nearly 40 federal services transactions. I'm going to start by throwing out a question and ask each of our panelists to chime in with an answer. I highly encourage, echo what Chris said earlier, if you have questions, please send them in. If we don't get any questions from you, then they're just going to have to answer my questions the whole time, which I imagine will be less interesting. So follow up on any of the answers that you've heard. Ask any questions that are totally unrelated to the answers that you've heard. Please type them through. I will be getting a subset of them as they're moderated themselves. They will come to me, and I will then be able to pose them to specific panelists. If you have a specific panelist that you want to pose your question to, please say that or write that when you type it into the system. Okay, well, let's begin. This has really been a incredibly exciting in a both bad and good way, 5 years for the private equity industry. And I want to ask each of our panelists to talk a little bit about what changes they've seen in the recent past, or really over their whole career. What changes have they seen in the industry? And even more importantly, what do they think going forward? What does that mean for what it's going to take to be successful going forward as a private equity investor? So let me start. We'll go in graduation year order and start with Dan O'Connell. So Dan, how would you answer that?
Well, unfortunately, I guess I'm the oldest guy on the call. So, but by the way, Andrew and everyone, great to be on here. Let's see. I think I got into the business when it was not even called private equity about 30 years ago, and there's just been dramatic change. But probably the biggest force at work is really the maturation of the private equity industry and the efficiency that's come along with that. It's different by geography and also different by industry, but in general, it's no longer a budding industry. It's an established industry, and one that gets a lot of press and attacks in ways. So I think that's been far and away the most important change. It's a result of economics 101. Private equity produced above average returns, and it has increasingly attracted additional capital and new players to the industry. But what it's translated into is a much more efficient marketplace where valuations are much higher, especially to gain control of companies, and a need to search in foreign different places to find special opportunities. So I think the biggest change, we started as a generalist firm, and I think that was the way to go in the early years. But increasingly with the efficiency and the maturation, the need to specialize and have some domain expertise has really been the way to go. And it's interesting with both Sally and Peter on here. Their firms were probably started a little bit later than ours, and they are more specialized and focused by industry. But that's been the biggest, probably the biggest necessity, is to have domain expertise and real knowledge in a sector. And also to be able to combine, investment prowess and history in a sector along with operating and strategic capabilities. So perhaps combining, people in your firm that have been in the industry from a financial standpoint for many years. So on the investment side, along with experienced operators or consultants who have really, bring that kind of skill capability, to the table as you look for new investments and then ultimately figure out, what to do and then what to do with them once you have made the investment. So I think that's probably the biggest change I've seen.
Thank you, Sally. You're up next. Sally, are you there?
Oh, sorry, it was on mute. Sorry. Yeah, as Dan said, the firm that I'm with, J.C. Flowers & Co., we do have a specialty focus on financial services. So I think that is a differentiating and a good fact for us. What I'd like to comment on is what I've seen change really since the financial crisis. I think what we've seen in the world is a real flight to quality, and I think that benefits the big private equity funds. They're just getting bigger, and I think that there has been and will continue to be a squeeze on many firms that are in the middle, both on the hedge fund and the private equity side. And so I think having a domain focus is very useful. I also think that the regulatory and the operational burden and expense has been growing. The industry has matured. There is a lot of scrutiny on the industry today, which is, as we all know, just increasing, not decreasing. The fact that everyone is being required to register as an advisor adds expense. The compliance is becoming more burdensome, and I think just the operational efficiencies and the maturation of the business is profound. I think that when it was a budding industry, some firms operated on a more casual basis. I just think those days are really not possible. I would say that risk is a big focus of the industry, and managing risk and thinking about risk slightly differently. And the last thing I would say is I think people are very critical. We've absolutely seen that in terms of the management teams that we work with and the need to really trust your management team, to test their integrity, and to know that you're aligned and that they can execute the strategy and the vision that you have for a portfolio company, because ultimately the business is still about delivering returns, and you really need talent that you can work with and trust in order to make that happen over the long term.
Thank you, Sally. Peter, you have comments on our opening question.
Yeah, I don't want to rehash too much of what Dan and Sally said. There's the way we've seen this. We've been in business now about 20 years, and the way we've seen this is there are very few free gain opportunities now. Right? There's not a lot of people who have a company for sale or a corporation who have a division for sale who don't choose to get professional representation. So generally, you don't find something hiding under a rock that's just free. That's changed a lot, probably certainly over the last 8 or 10 years. There's no question that we were a generalist firm. Now we're a specialty firm, and we've been specialists probably for 7 or 8 years. And it's made a big difference because in what we do, we see most of the opportunities in our area. And sure, there's competition, but it's nice to be known as somebody who understands a business, particularly something that's a little maybe esoteric. The bigger firms, and Dan probably can speak to this obviously, but the bigger firms have subspecialties generally, I would think, and you see that if you look at big firm websites. So it really helps to actually understand an industry and try not to go from ground zero to a high speed in a short time frame. You have to look at something to assess it. What we've seen, and I think what's happened, is that it's great in a rising tide economic environment where everything's good and buyers look smart when they sell things because the businesses grew. I think, you know, we're in a prolonged period now where there's going to be no freebies there either. And so the differences are going to be made with what you do with what you buy, and you're going to have to deal with that over a longer period of time. So if you could recap a company in 18 or 24 months or make it look pretty and sell it in 36 months, I think the, you know, make something improved operationally may take 48 months before you see the results of your first 2 years of activity working with a new management team or something. And so that'll be, that has been shifting, at least we've seen that shift. That'll probably continue. And then the question is, so what gives? You know, how are you going to be competitive? Are you going to put more equity into deals and keep high prices, or should prices come down? But regardless, I think we're in a period of sort of lower expectation returns, and you'll do your best to get what you used to get 10 years ago. But I think over the longer term now, you know, with other returns being so low in the stock market, whatever, the comparisons are better, and you can say, hey, if we're going to return 15% or 22%, that's going to look really good compared to, you know, NASDAQ trading at 5,000 and people could get 30% a year liquid. And so we've seen sort of a longer horizon, you know, hold, and you've got to be the difference in making it a better company.
Yeah, this is Dan again. Maybe just I agree with Sally and Peter's points. I think the other major trend along with what we've been talking about is a bifurcation of the industry into the larger players who are you know, the former mega firms, but now they're more multi-asset class, multi-strategy. Oftentimes they'll have an advisory business in there, like the Blackstones and now KKR, and becoming more like, and public, so more like an investment bank to some extent. And then you have you know, the boutique firms who are more focused by industry, geography, stage of investment, that type of thing, and have probably elected to remain smaller and more focused. So I think that trend of the continued you know, bifurcation of the industry is underway. It'll be interesting to see where it ends up in the next number of years, but that's, you know, firmly underway right now.
Thank you, Dan. A theme that's come out of all of your answers, and I wasn't expecting it to come out so strongly in all three, but it did, was the value of specialization in the modern private equity industry and why it's necessary even for very successful older generalist firms like Vestar. So I actually have a specialization follow-up question for each of you, and let me prompt you with what that question will be, and then maybe we'll go this time. We'll start with I'd like to start with Peter on this question, and then go to Dan and Sally. The question that I'd like you to answer, Peter, is you said your firm started as a generalist firm and then made the decision 7 or 8 years ago to specialize in the federal services sector. So I'd like to get a little sense for how you guys made that decision, which seems like a pretty big bet to make 7 or 8 years ago that has turned out to be a very, very smart bet. Maybe that's why you're on the phone with us today. If it were a dumb bet, we wouldn't have found you.
Right.
But it's a smart bet. How did you make that decision? And is it something that you're constantly reevaluating? Is your firm asking, hey, is this drying up and should we be doing something else? So I'd like to ask you that to start, and then I'm going to ask Dan, who said that Vestar is getting a bit more, getting more specialized and thinking more about it, led us off with that, to talk a little bit about how you guys thought about that question and how you're going forward. What is the specialization and what's the decision making? And then to finish off with Sally, whose firm is famously specialized, to ask whether you feel as though any part of that specialization needs to change going forward. Is it that you always will remain, since that's where your domain expertise is, in financial services? But if so, are you shifting around in it? And what is the actual mechanism by which your firm makes those strategic decisions? Back to our business school case study way of thinking, how would you decide how to shift within that industry? So starting now again with Peter, could you tell us a little bit about how you guys thought about making the shift, which seems like a very, it's a big bet, and a big bet that certainly has paid off, but how did you think it through?
So there's not a lot of science on this, at least here. So we did our first, we were in business for 3 or 4 years doing generalist deals, and we did our first federal deal. We took a public company private in 1995. And that was, and frankly, we didn't know more about the industry at that point than we knew about, let's say, food before our first food deal. We just didn't. It would seem like a good opportunity. And so then over the ensuing 9 years, and in 2004, we said, that's it. We're not going to do this other stuff again anymore. So it took 8 or 9 years. It was an evolving situation where we did more and more of our activity was in that sector. Services companies, primarily serving federal government or state and local governments. So it evolved. It wasn't a, we're going to switch directions right today. Not at all. And over that time period, we were seeing results. So we actually were doing very well in that. We had to question why. Part of it was we understood it. And then we were not doing as well in other things where we were, blind competitors against, in cases, some really good specialty firms. You buy a food company, but you're competing against food specialists. Very hard. So it evolved. And why did we do that? We did it because it turned out we looked at we liked it individually. It was a passion, personal interest. You got more excited about pursuing deals like that. They would come in because you had experience, people knew you, and it just became a virtuously positive cycle. But the questions we do, so it's not science, it was an evolution. What we constantly do is ask ourselves, are there enough opportunities to keep going in the sector regardless of, headwinds at times, whatever, sometimes tailwinds, but headwinds at times. And is there a life cycle of companies, and do they need capital, and do they need our kind of capital, and can it compete with, let's say, a strategic buyer paying a higher price who has advantages over a private equity firm? So that's a question we're always asking. So we're always trying to make sure that we're competitive is the best way to do it. And you can, and the last thing I'll say is, we're specialists in human capital oriented services companies. That actually has a lot of application beyond just a certain type of customer. You can have commercial customers, you can have state and local customers, et cetera. And so we edge out all the time as long as we understand the type of activity these companies do. And then the elements that make it successful is sort of the experience set that we bring to it, and we apply pretty much the same thing over and over. So anyway, that's it.
Now, just one quick follow-up question, because I want to try to realize one of the benefits of specialization is just that you know more, you see more deal flow. Those are very helpful. Does it help you actually at the investment stage? Are you able to compete other than with price? So are you able to get deals other than just a pure auction, even when someone is bidding a little bit more because people would rather be in business with you because of your track record and expertise in the area?
If you're asking me, I'd say yes, absolutely yes. Specialization will generally break ties on price. Mm-hmm. And in a recap private equity situation, if there's what they call second bite of the apple, a further opportunity for an owner to get more later, or the management team to get more later, if they think you're going to help them, and there are many ways to help them, but if you're really going to help them because of your knowledge and the non-meddling but active involvement, you could actually win the day with a slightly lesser price. But at the end of the day, I'm afraid green talks a lot.
Okay, thank you. Dan, so the question to you is, as a generalist firm that's now doing more of this evolution and thinking you need to be specialized, you're the one who introduced that topic. And same question to you, which is, what's the thought process, and is it that you will have one specialization? You guys are a big place, so one might be too few, or multiple specializations and multiple teams?
I think we went through a similar kind of process as Peter's firm. Many years, we were totally generalist oriented. Actually, resisted specialization in the early part of the evolution, feeling that we did not want to chase up valuations in sectors as they became hot or whatever. But ultimately, the business became so competitive, and the evolution of deal sources being lined up by industry, we realized we needed to make the switch. We initially did it informally, where partners just began to focus on the sectors they had the most experience in. But then we decided to formally align the firm by sector, and we picked 5 big buckets, initially, where we had a track record, things, consumer and healthcare, financial services, those types of things. But then over time, we've become even more focused in each of those larger buckets into subsectors of each of the industries, and have grafted on. The new people that we've added have largely come out of those industries and have a point of view and a capability in a certain subsector that we feel can help our deal flow or help us add value to the companies that we invest in. I think the key thing is not to get too specialized by subsector, and to have some an ability to be flexible, because opportunity flow and valuations go up and down, so you need to so people aren't just sitting on their hands for a number of years when a certain sector gets either is not opportunity rich or valuations are too high, so you do need to keep some flexibility in the system. But nowadays, in order to succeed, to get the proper deal flow, to be able to pay the clearing price, management teams want an informed owner, whereas maybe 15, 25 years ago, I think they wanted you to know very little about their business. Nowadays, they realize that it's so much more competitive out there that they want an owner or a partner that can add value to their business. So it's a critical dimension. So.
Thank you. Sally, your firm is famous for being a great specialist, and I wonder how you think about that going forward. Certainly, there's got to be a lot of opportunities in the financial world right now, so nobody's scrounging around having to look for anything. But I also imagine it's become much more competitive with everybody coming into your space, and I'm curious as to how the specialization of your firm has really helped you as more people are in the industry, and how you think about that going forward.
Yeah, well, it's true that we are and always have been specialized, focused on financial services. That's all we know. It used to be back in the early 2000s that nobody really knew what that meant, and nowadays you're right. Everybody wants, or many people certainly over the last four years thought it would be a great area to get into. So it is more competitive, but particularly in the U.S., it's more competitive. So the financial services space is a large space. It has been a challenging time, particularly if you invested in 06, 07 vintage. A lot of those companies have gotten in trouble. But one of the things that benefits us is that we have a global focus. And so deals in the U.S., I would say, are much more competitive, where price does matter the most. It's not the only factor, but what we have found is that outside the U.S., the relationships and the ability to get regulatory approval from banking regulators in other countries is not as easy as one would think. And having a track record, having a network, having a long experience in other jurisdictions matters a lot. So in the past 12 months, we bought a company in Belgium, and the Belgian regulator cared a lot about what the Luxembourg regulator had said when we were approved for a transaction in Luxembourg back in 2007, which we still own today. So we were able to demonstrate we're still an owner, we've created value, we've been there during hard times, we've stuck with it, you know, during good times. We were not flippers. There's a lot of skepticism that private equity is just coming in to flip and make a quick buck. And so I think that has helped a lot, is that the reputation among the people making the decision, which in our field is the regulator often, as well as the seller, matters a lot. I would also add, I think it might have been Peter who talked about the network, both in sourcing deals as well as sources of capital. And we certainly feel that that's true, that having a vast network does mean, if you're a specialty-focused firm, that you get the call and you can demonstrate to a seller or a management team that you have the resources, both from within your firm and from within your network, to help make operational improvements and create value over the long run. So we're not going to get out of this, this focus, but we do apply it to new jurisdictions and new areas within financial services that, you know, might prove to be opportune.
Thank you. That is helpful. A note: I can see we have 127 people on the attendee list, which is a great number. But nevertheless, I have no questions from all of our attendees. So you guys are just going to have to keep listening to my questions until you send some in. This is your chance with this group. I do have some questions, but they're probably less interesting than yours. Let me throw something out to, again, each person, and I'll this time start with Sally and then go to Dan and Peter. And this question is to try to get some advice out of the 128 now people that we have on our attendee list. I expect that there's a fair number of young alums and students that would like to be working in this industry at some point, and we all understand that jobs are quite hard to get right out of school, but people, after they have a certain amount of experience, can make a contribution to your teams. And I'm always asked in my faculty role, what kind of experience can I get? What is thought of as most useful, both in terms of a skill set and also specific domain, specific silo type experience that I could have. So for people who you would be looking for to join your firm, I think, Dan, you had talked a little bit about where your recent hires were from. Nice to hear that you're making recent hires. I'd like to get that from the group, say starting with Sally. What do you look for when you're looking for people, and how often are you actually looking for people?
Mm-hmm. So we actually are a bit of a big business in a small company. So we have about 45 people who work in this company, and that's in New York and London, and that includes professional and non-professional. But one thing that I would say is, and maybe it's different for Dan and Peter, or certainly for the mega firms, but a private equity firm such as ourselves it's not a training shop. So we do not hire people who have not had some training, generally in bigger institutions. And so one bit of advice I would give is, I think having a couple of years in a big bank or a big company where you've really developed your analytical skills and gotten exposure to a number of problems is very, very good training, and we're not able to really provide that. So, you know, we hire people who can hit the ground running, not that they need to know everything about our business, but who have the analytical skills that they've acquired and honed somewhere else. The second thing I would say is that developing abilities in some detail, in some area, is very good demonstration of the ability to apply that to our industry. So we don't need someone who is already an expert on valuing banks or valuing insurance companies. But if someone has developed an expertise in an area, that demonstrates to us that they have what it takes to slog through the details and get up the learning curve in our space. And that requires an attention to detail and a curiosity and a willingness to ask questions and learn that if someone has just had only very, very high-level general experience in everything they've done, I think it's harder to demonstrate that. And you need to be able to work with people. Just having the analytics isn't enough in our business. I think the private equity business is a people business. It is working with the management teams at companies. Private equity teams tend to be small and collaborative. That's certainly true at our shop. And I tell everybody that the key to success here is to check your ego at the door and be willing to, work very collaboratively and work with people, be a good judge of people. So that's my advice.
Thank you. Thank you for that. Let's go to Dan next on this one. Since the good news is, Dan, we've heard that at least you've hired somebody in the last year.
Well,
that makes you different than many businesses based in the United States. Same question for you.
Yeah, and I would agree with all of what Sally just said. I think the career path into private equity has changed quite a bit over the last number of years. I think traditionally most of the folks came out of investment banking, then consulting became a big path into private equity. But again, most firms are not set up to train people, so they're looking for folks that have got anywhere from 3 to 5 to 10 years of experience. But increasingly, you're finding people with operating background moving from companies into private equity, and that have the sector expertise and understand the complexity of certain industries and where value's going in that industry. So whereas I think the traditional folks in either college or business school wanting to get into private equity would think investment banking or consulting. I think nowadays, if you're passionate about a certain industry that has a lot of change, hopefully growth, and some complexity to it, starting out, in business, and whether it be on the financial side or operating side of a company, is maybe as good a path long term into private equity. And it could be ultimately moving into a company that is owned by private equity firm or firms, and impressing those folks with your capabilities there, and then moving into the business. But our firm today, we have 30 professionals, 20 partners, and of the 20 partners, 10 have run companies or been CFOs of companies, and that's very different than what we were 10 years ago. I think we had very few former operators as partners in the firm. So going the corporate route is perhaps as good a path into private equity today as investment banking or consulting. I would not have said that 10 years ago.
Thank you. That is a change from the advice that we would often hear 10 years ago. Peter, do you have anything to add to these comments?
Yeah, I just had a couple of quick things. So the thing that makes the people here, some of them better than others, let's say, at doing what we do, is at the end of the day, you need to understand how finance and accounting work. That's sort of the basic building blocks of understanding the language. You need to understand something about operations, right? And you'll learn a hell of a lot over time. But you've got to have the fundamentals. But what's most important is understanding people, and I think Sally talked about this. So for us, it's understanding what management really needs to be interested in doing business with you, or staying interested over 5 years. Understanding what motivates sellers and why they will do your deal, as opposed to doing the deal with the big company who might eviscerate their employee base, but they want to do it with you because you understand them and you're willing to bend and work around them. Understand, and then willing to deal with operations and problems and people issues. It's easy to replace a machine. It is really hard to decide when to replace people and at a company. And why, is it their problem, or is it your problem, or is it the dynamics of the industry, but they're really good. So those are issues that you don't get as great as, let's say, SOM or some other business school is. You really don't get that in a classroom. And so you get that through working in some business for a while and interacting on elements like that. The last thing, so we like Sally and Dan, don't hire people out of business school. We actually hire people that have come with some skills that apply to what we do, and maybe even industry skills, specialty. The other thing that we've found, and I hear this a lot, is the most likely candidates to get hired into a private equity firm, because they're so small, are individuals that have worked with the firm in some way tangentially. Maybe they were at an accounting firm that did due diligence for private equity deals, and so you learn what the person's like, intelligent, smart, affable, etc. Maybe they're at the investment bank, or maybe they're at a consulting firm that's done work with the private equity firm, and at some point that individual crosses the line from being a client service person to wanting to be an employee, and may say, I'm thinking about getting into the private equity business. Could I talk to you guys? And et cetera. But it's often, small firms hire people that they know and have seen in action. They rarely will just go hire somebody off of, Monster is a joke, right? They wouldn't do it off of Monster, but they do it with somebody they have exposure to.
Thank you. So it turns out that we were getting some questions, but due to a technical glitch, they weren't coming through. They weren't coming through to one of our moderators. So I apologize for chastising people for not sending things in when we were indeed getting them. And I now have a list of questions in front of me, many good questions in front of me. So let me address them to specific panelists to get their reactions. The first question, I think I'm going to come back to you, Dan. I think it's most applicable at this stage to Vestar as one that may be thinking about these issues. And the question is, there have been few successful leadership transitions apart from the IPO route. I don't even know if we would think that that's a leadership transition. How do you think about firm continuity, and what strategies are you pursuing to ensure young talent stays and older professionals do not become free riders? That's not to be taken personally.
No, good question. I think the key thing is the the governance of the firm and how that's set up, and really the culture that you establish over the years, and whether you really do have a true meritocracy. But and being transparent to folks in terms of how things are allocated and how decisions are made over time, and you definitely do have to plan for plan for transition, plan for succession. We're actually going to, even though I like to think of myself as a young guy, I'm not a young guy anymore. Our investors do care about who's next. So we have different leadership roles in the firm, whether it be chairman of investment committee, chairman of our new business efforts, and other leadership roles. So making sure that we're identifying people and bringing them through those positions over the years. So, but I think the key thing is transparency, meritocracy, ability to adjust things over time from an economic standpoint, and having different roles for folks to show their leadership capability and be able to step in when and if the time's right to make a change like that.
Thank you. I addressed that question to Dan, but that's not to say that Sally and Peter might not have something to add. I just don't want to put you guys necessarily on the spot. If you do have something to add, would you like to comment on that at all?
Well, I would just say I think it's an interesting question in the industry today, as a lot of the firms where the founders are still very active. I think it's going to be interesting over the next 10 years to see what happens, and whether there are any casualties, or most of the firms that are well established, even though the founding partners are still active, can transition. And I agree with Dan's comments. I know even though I'm at a firm where there's one person whose name is on the door, we have moved towards a more broader governance structure. And I think exactly as Dan says, that showing your investors the leadership of others within the firm is, I think, is the key to having a stable transition.
Well, speaking of transition, Sally, I have a specific question for you, which comes from one of our participants, which is, how does the Jobs Act affect fundraising for private equity firms, as well as does it have any effect on the portfolio companies for JC Flowers? This is a question directed specifically at you and your expertise.
Well, it hasn't affected us very much, I would say. So let me just think about that a moment, since it really has not affected our companies that much. And maybe that's because many of our companies in the U.S. have not. So it really hasn't affected us that much.
Okay.
The answer.
And let me address this specific question to Peter. As a specialist in an area where certainly your firm has developed a lot of operational expertise, this is a question from one of the participants. How deeply are the partners of your firm or the other investment professionals at your firm involved in devising strategies for the portfolio companies? So how operationally engaged do you get in your portfolio companies?
Fair question. I like to say that if somebody does business with us, we will not meddle with their business or in their business, but we'll be actively educated about it. Some of these companies are kind of small and don't have the formal processes or the full team they ought to have. So we'll go in, and we'll have some people that have worked with us for a long time go in and maybe be sort of a teacher, coach, leader, not a business leader, but sort of lead them into how they ought to structure business development or something like that. And maybe there is no business development person formally, so you need to go hire somebody. And so we can help actually with that because of our network and connections. So we're pretty involved in making serious suggestions, and if they've got a better way to do it, we'll listen. But we don't sit on them. We don't park someone there. We don't go once a week for a full day. There are a lot of private equity firms that actually spend so much time with the management teams. I don't know how the management teams have time to do their work, but we're quite involved in getting them up to speed and then monitoring them, so to speak, and sort of being available, talking to the CEO once a week or maybe 4 times a week if they want to. But it's not parking there. And there's a big difference between meddling and being knowledgeable and then acting as a suggester sounding board. So if that, and I'll just add one thing. We think we're pretty involved with our companies. One of the CEOs was quoted as saying that we're quite passive. So it depends on the perspective.
Well, I guess relative to his expectations. Maybe he heard some horror stories.
Right.
I've received a few really very good questions from a career perspective that follow up on the career discussion that we had earlier, and I'd like to address them. I'll just address this first one specifically to Dan, but then ask Sally and Peter to be thinking about it. So if you have anything that you want to add, please do. There's really no reason that I'm throwing this to Dan except that it's his turn to get tortured. So the question, and this is one that I've heard many times also from friends of mine, which is if you're an experienced manager already at an operating company, and you would like to be involved, you'd like to become a manager in a PE-backed enterprise. You know, a lot of the best managers want to do that because they understand that's their best chance to get rewarded for being good at what they do. And some of them have even been involved in a deal or two before, but aren't considered in a regular rotation of folks that get called upon by the firms to come in and help out with most of the deals they see. Is there a way? I mean, how do you go about finding the people that you want to put into place when you do put folks into place at your portfolio companies? So that's for you, Dan, but for anyone else to chime in after we hear your insight.
Yeah, I think each day at Vestar there's probably 5 to 6 meetings that are happening with managers in some way, shape, or form that are looking to move into the private equity business. Those introductions come about, through headhunters, through other advisory firms like investment banks, attorneys, consultants, accounting firms. But I think if you're a capable manager, you probably know how to network in some way, and if you want to meet the right folks at different firms, it's not a hard thing to do. Certain firms have more of an open door policy to meet people. I think, and probably the firms that specialize or have specialties are probably more open in that regard. But we encourage everybody here that if they get a phone call to be introduced to somebody, that's a meeting that we should definitely take, and they should be out searching and talking to folks to be always on the lookout for smart, capable people. So it's not hard to get into the flow like that. And actually, a couple of our partners were folks that sort of came in over the transom and had a reputation and were known to be capable, good managers, and it took a while for it ultimately to connect. We asked them to numerous meetings, asked them to look at a deal or two with us, maybe served as an advisor or consultant on a potential investment, so we get to know them a little bit along what Peter was talking about earlier, and then ultimately maybe ask them to be on a board of a company or a senior advisor to us, and then ultimately it might turn into a partnership. So it's a gradual learning, feeling out process. But it's not hard for managers to get access to private equity firms, and you just need to, stick at it, and you'll see, and things will happen if you are capable enough and you make the right connections.
Let me follow up on one thing that you said, because another question that we got, which is related, and you touched upon it in your answer, is that many private equity firms will employ a consultant. I don't mean a consultant as in McKinsey consultant, but a consultant who's an industry expert, especially during the due diligence process. This would be something prior to actually hiring them to work in one of the firms. And I wonder, is what you're describing as a way to get involved and to eventually hook up with private equity firm are the same steps that might get somebody ultimately placed at one of these firms? Are those the same steps someone takes just to let you know they exist and you might want to use them on the due diligence part of a project? Or is there something different that you do for that?
No, I mean that is the way it comes about. Or we may reach out to to a specialist in the industry to introduce us to a few people that they feel really know that particular sector. And so either we proactively go out and try to find folks that can help us to look at a particular opportunity, or we will have met this person and we'll have something that we're looking at and ask them to look at it with us. And it may start in a very informal kind of way, and then ultimately move into a more formal type of assignment or engagement or whatever it may be. But it really covers the gamut.
Thank you. Sally or Peter, if this is something that you have, that certainly the expertise to answer the question on, I was wondering if you had some thoughts that you wanted to add. If not, I can just go on to the next question.
Well, I would just say I think that certainly for our company, because we are small, we leverage extensively on outside resources, and it is easy to get in the door, establish a relationship, bring us a product, an idea, a relationship, help on due diligence, help with a new opportunity. Board service is a very good way to get involved with with the business. So I think there are a lot of ways, even though it might not be coming in as a new employee, to establish a relationship and get your foot in the door that way.
Okay, thank you. I think we have time for one more question here. I have many good ones, so I apologize to the people who sent in questions and that I won't be able to use. But let me ask something that's somewhat open-ended and also future-looking, so that it provides an opportunity to talk not just the answer to this question, but other things that may be related. And it's something that comes up a lot. One question that came in that said, do you believe that the current private equity industry is right-sized to the size of the opportunities that are available? I mean, is there too much money chasing the number of deals that we have? Do you think that there's going to be a retrenchment going forward, or is it quite the opposite? Since Peter got off the hook on the last question, Peter, I'll start with you, again leaving it for Sally and Dan if they have some thoughts to chime in after.
So we're a smaller fund, so I sort of look up at these very large funds and think that there's a heck of a lot of money chasing what appears to be, not enough opportunity. So I generally think when you look at the backlog, and there's some great graphs about this that exist, when you look at the backlog and the funds raised that need to be deployed, it appears there's a lot of money, maybe not too much, but there's a lot that needs to go out faster than it has over the last 3 to 5 years, or else you sort of use it or lose it in that concept. I think the stock market is big enough, so if a number of the companies that are public start going private, you'll probably use it up. But I think the private companies that are just trading hands, or some seller-owned, operator-owned private companies, probably not enough. In our sector, I think it's fine. My specific sector, we're okay. But this is a niche.
Other thoughts, Sally or Dan, on the right sizing? Are we right sized, or is there too much money?
Yeah, my personal opinion is that the industry is going through a rationalization process right now. I think in general, I mean, in certain sectors, specialized sectors, and certain geographies, there's less capital, less people chasing things. But in general, for your mainstream type of opportunities, there is an overabundance of capital, overabundance of firms chasing things, and investors are rationalizing, who they're going to go with. And I think that's probably going to continue for the next, next couple of years, and things will stabilize. I think it also depends on what investors. I think there's going to be a realization that investment returns in the private equity space are going to be lower than what they have modeled in, or what they expect from the category. Depends on where interest rates go, or whatever. But the days of a steady 15 to 20% plus returns are not going to sustain, I think, in this this intermediate term here, and things are probably more in the 10 to 15% range. But the industry is definitely going through a rationalization. Investors are being more selective, and costs and terms are being tightened up meaningfully, and there will be a sorting out process over the next couple of years.
The only thing I would add to that, I agree with all that, is that I think, and maybe this is just true for what we do, but there's been a slight, over the last 6 months, paralysis in terms of waiting to see what's going to happen in Europe and what's going to happen in the Eurozone. And there's a humongous need for significant capital, particularly in that region. And I think that if there was some greater clarity or sense of calm around what's going to happen in Europe, I do think the capital could, the spigots could really open. That a lot of people have just been holding on to their powder, waiting on the sidelines to see what happens. So I think it could all shift quickly, even though it might feel there's over an abundance today. I think if it starts getting really deployed, that will make a difference, and if the interest rate environment changes.
Boy, I would love to have another hour to talk about Europe. That's a really interesting topic. Do you think? I mean, when you say
get that out there, yeah.
People are holding on to that, would you say that that is fairly specific to your industry, to the financial services side, where clearly there's an enormous need for capital and a lot of nervousness, or are you, in your broader experience, seeing that that's really true all over private equity, not just on financial services investment?
I would say it's true all over. I think there's a huge ripple effect. You know, I just think there's a huge ripple effect. I mean, we see it. So we own several banks in Europe, and you know, for example, one of the banks we own, you know, it's just hard to make corporate loans because none of the corporations in their region want to spend money because they're nervous, and they're themselves not in the financial services business. They're in every business imaginable. So I think there's a huge ripple effect that has really paralyzed people to a certain extent.
I do wish we had another hour for that, but I can see we're out of time on our hour. Chris, did you have some closing remarks that you wanted to make?
Sure, yes. Thank you, Andrew and panelists, and thank you all for joining us. Please send any additional comments or questions to Yale SOM at som.yale.edu. A recording of this discussion will be made available at the Yale SOM alumni portal, which is alumni.som.yale.edu, and at qn.som.yale.edu. Thanks, everyone.